How to invest for beginners. Welcome to Investments 101. In this video, I'll cover everything you need to get started in investing, even if you have no prior experience, have never bought a stock before, or made any other previous investment. But more experienced investors might also benefit from this video because I'm not just going to tell you what to do, but I'm going to explain exactly why these steps are crucial for long-term investment success. To do this, we'll go through several examples and also walk through the custom spreadsheet I built to help explain each step of this process. This is the exact advice I would give to myself if I could go back in time to when I was just starting out learning about investing. Before we jump in, make sure you're subscribed to gain access to more investment content like this. Now, many times when people start learning about investing, the first thing they want to do is just jump right into it and start buying their first stocks and securities. However, before you do that, you should ensure you've completed the first step, which is to build a solid financial foundation. A solid financial foundation for you consists of two components. First is that you should have no, low, or manageable levels of debt. Ideally, if you can be debt-free, that'd be great, but you want to make sure that your debt payments are at reasonable levels so that they don't have the potential to interfere with your investment decisions. The second component of your financial foundation is to have fully funded cash reserves. It's always important to have some cash on hand for the surprises that life brings us, but ideally you want to make sure you have enough cash on hand, which allows you to take long-term investments while mitigating risk in the short term. Going back to debt, let's use this example to explore why paying off your debt before you invest is almost oftentimes the best financial move. But we'll also cover when it might make sense to keep some debt instead of paying it off. This graph here is a comparison between estimated investment returns on various types of investments versus your debt threshold. Now, your debt threshold will be unique to you, but for most people, it's the highest interest rate on any of your outstanding debts. So for instance, in this example, the debt threshold for this individual is 4%, meaning that the highest interest on any debt that they have is 4%. For an individual who is completely debt-free, their debt threshold would be 0%. For a person with no debt, we can get an estimate of what their returns are likely to be for putting money into different investments. For instance, cash or money market returns yield roughly 2.4% right now, while long-term corporate bonds are yielding roughly 4.3%. Returns in stocks or equities like the S&P 500 historically in the past have returned about 8% per year. However, various economic outlooks, including that from Vanguard, predict that future returns from global equities are likely to be lower than what they have been historically. This is in part to generally higher levels of equity valuation, which usually means lower future returns. So given that over the next roughly 10 years or so, one could probably expect on the high end a 6.5% annualized return for stocks, or on the low end a 4.5% annualized return. Again, these are estimates, so the actual results could be higher or lower, but this is the range we'll be working with for this example. For someone with no debt and a long investment time horizon, they have the ability to take on more risk to potentially achieve a higher rate of return. Investing in riskier equities here will likely give them a return between 4.5% and 6.5%, and if they wanted a low risk option, they could get a 2.4% return by keeping their money in cash and money market funds. But what happens to these investment options for someone who has debt? When you have debt, you have to pay the interest on that debt regardless of whatever returns you get from your investments. Effectively, this means the net return, or the returns from your investments minus the interest you have to pay on the debt, is significantly lower than what you'd get if you were investing debt-free. In this example with debt with an interest rate of 4%, the interest cost is represented by the red line. Only the portion of the blue bars above the red line represent the net investment gain that you would earn after paying interest on your debt. In this case, it makes a couple things clear. It doesn't make sense to have any investable cash in money market funds yielding 2.4 when you're paying 4% interest on your debt. In that case, you'd be much better off by simply using that cash to pay down that debt, where you'd get a risk-free 4% return. Unfortunately, with corporate bonds yielding 4.3%, that isn't a huge net investment gain you're getting by earning 4.3% while paying 4%. Investing in stocks, on the other hand, at least gives you some chance of potentially outperforming the interest rate on your debt. However, the returns you get from investing in stocks are not guaranteed, whereas the interest on your debt you'll need to pay every single month. Now, in the past, where returns on stocks were higher, say for instance 8%, one could make the argument that it makes sense to not try and pay off that 4% debt early, because you could simply invest the difference in the stock market at 8% and get a net 4% investment gain. However, with higher valuations leading to lower projected future returns for stocks, it makes paying down debt a relatively more attractive option on a risk-adjusted basis. The thing is, though, 4% isn't even that high of an interest rate. The average interest rate on student loan debt is roughly 5.8%, which makes it a relatively obvious choice to prioritize paying that off completely before doing other investing of any kind. And if you have any credit card debt at all, usually with interest rates of 15% or higher, you should not even be thinking about investing at all until you have that debt completely paid off. Every dollar you use to pay down that credit card debt, you're effectively getting a 15% return, risk-free, an option that's not even close to available in any investment aside from paying off your own debt. So generally, what are the threshold levels where it makes sense to pay off debt, where it makes sense to keep debt, and where there's a little bit of a gray area in between? Well, it might vary for you. My guideline is if you have any debt with an interest rate of 5% or more, you should prioritize paying that debt off completely before doing any type of investing. Paying off anything at or above 5% makes a lot of financial sense because not only is it a high risk-free rate of return, but you get the added benefit of improving your financial situation and reducing the stress from having a lot of debt. If you have debts with interest rates below 3%, it's about at that point where you could consider keeping that debt instead of aggressively paying it off, and instead investing the difference for a higher rate of return. While it still wouldn't make sense to invest in risk-free money market funds, corporate bonds and equities do have expected higher rates of return, which should allow you to benefit from the net investment gains long term. Debts with interest rates between 3 and 5%, it's up to you to decide whether you want to pay them off quickly or invest the difference. I would generally suggest even to pay off those simply because it's a risk-free return and being debt-free feels pretty good. Once you have your debt under control, the second part is to make sure you have enough cash. In economics, there's a concept called utility, which is effectively the amount of economic benefit you get from a certain quantity of something. Everyone has their own personal utility curve when it comes to money, but for most people, it generally takes a shape like this. When we don't have that much money to begin with, we value an additional dollar much more compared to if we were more well off, where an additional dollar doesn't really make as much of a difference. This transition from a relatively higher value placed on an additional dollar to a lower value placed on an additional dollar is a concept called marginal utility, specifically diminishing marginal utility. This concept explains that the first unit of consumption typically provides the most utility, with subsequent units providing less and less utility. Best way to think of this is an example, let's say ice cream. Whatever your favorite flavor is, I'm pretty sure the first scoop is just delicious on a hot day. The second scoop is still pretty good, but after you start getting past the third scoop, your stomach might be a bit unhappy later. Marginal utility applied to money has a specific manifestation in what's called a liquidity preference. This concept was first developed by economist John Maynard Keynes, and according to him, the demand for liquidity was based on 3 motives. The transaction motive, which is we want cash available to us to perform day-to-day transactions. The precautionary motive, where we want cash in case something happens, just so we're able to cover it. And the third is the speculative motive. We want cash on hand if we believe or speculate that the prices of assets might fall, so we can then buy them at a lower price. The practical application of liquidity preference put into action is a cash reserve fund, sometimes called an emergency fund. The reason we want a fully funded cash reserve is so we have enough cash to satisfy those 3 motives. Now, you've probably heard the generic advice of emergency funds: set aside 3 to 6 months of expenses in cash in case there's an unexpected expense. However, we'll be going over 4 different levels of cash reserve size and how they meet or fail to meet some of those liquidity preferences we discussed earlier. So these cash reserve levels are based on a monthly expense of $2,000 a month, which may be more or less than you're spending. If that's the case, you can simply adjust the values to match your level of spending. The first cash reserve level is effectively your minimum cash buffer. This is 1/2 of your monthly expenses. Even if you have debt, this is the minimum amount of cash you should have available at all times. The reason for this is this covers the first transactional motive for liquidity. 1/2 a month of expenses is the minimum you should have because it'll get you through to the next paycheck for most all of your day-to-day transactional expenses. Having less than this minimum amount will put you in a bind if you need to meet daily expenses, but find you don't have the cash to do so. Once you have your minimum cash buffer and are making progress on your debt, then you start to move to the next level. This is effectively 3 months of expenses, or 3 times your monthly expense. At this point, you've satisfied the transactional liquidity motive completely and are starting to make progress on the precautionary liquidity motive. Unexpected expenses do come up, whether that is a job loss, a health expense, or just a sudden trip that you find out you need to take. Without a sufficient cash reserve, what could potentially happen is that you don't have the liquidity to pay for any of those unexpected expenses, and instead you have to sell off some of your longer term investments at an inopportune time simply to meet those liquidity needs. Unfortunately, as life sometimes happens, bad events are correlated, and oftentimes you'll get not just one piece of bad news, but several in a short period of time. During the financial crisis in 2008, not only did many people lose their jobs, but some of them even lost their homes, and that's not even mentioning the value of their investment accounts, which were likely cut in half. Unfortunately, in 2009, when it was one of the best times to invest in stocks, many people had to sell off their investments because they simply needed the cash. Fast forward 10 years where those stocks have tripled in value, you can see the importance of having cash reserves to make sure you can keep your long-term investments untouched. While 3 months of expenses is a good start for this emergency fund, ideally I would recommend at least 6 months of expenses. The reason being is that this gives you at least half a year to sort out whatever life throws at you. And if you want an even higher level of protection and or enough cash to possibly satisfy some of that speculative motive, then I would suggest going with a full year of expenses. And if, for instance, there's an interesting investment opportunity, you could potentially invest half of that cash in it and still have 6 months of expenses left over. This flexibility that you get with more cash can give you more peace of mind as well as more options when interesting and attractive investment opportunities come up in the market. So overall, before you really start investing, you want to build a solid financial foundation by paying off your debt at least to a low manageable level and giving yourself the peace of mind and financial flexibility with a fully funded cash reserve. Once you have that done, you can move on to step 2, which is to develop the right long-term mindset. The graph we'll be discussing behind me actually comes from a presentation from JP Morgan Asset Management. They provide market insights in their quarterly guide to the market presentation, and one of the most interesting slides is near the end of the deck, which discusses diversification and the average investor. In that slide, they included the 20-year annualized return by each asset class from 1998 to 2007. Over this period of time, real estate investment trusts were the highest returning asset with an average annualized return of 9.1%, followed by gold at 7.8%, the S&P 500 at 7.2%, a 60% US stock, 40% US bond portfolio at 6.4%, oil at 6.4%, 40% stocks, 60% bonds at 6.1%, developed market stocks at 5.7%, bonds at 5%, single-family homes at 3.4%, and overall inflation over this period of 2.1%. Now, despite the return from almost all these asset classes being over 5% per year, how did the average investor only manage to achieve a 2.6 annual rate of return? And note, that's just barely keeping up with inflation. At the end of those 20 years, there's very little real appreciation in terms of what you can buy with that investment. Now, part of the reason why returns for average investors lagged most asset classes could potentially be they didn't have a solid financial foundation, but just as likely, and maybe even more so as a contributing factor, is that the average investor simply doesn't have the right mindset for long-term investment success. A large part of that being driven by investor behavior and emotions. During the financial crisis in 2008, when it looked like the financial markets were about to collapse, the S&P 500 was down roughly 50% since highs in 2007. Many investors emotionally sold on fear just to try and preserve whatever was left of their investment accounts. Unfortunately, when you trade on emotion, you're usually going to get the short end of the stick on both ends. Because we don't like losing money, fear tries to compel us to sell our investments and protect our capital only after we've incurred a loss. Conversely, after large increases in gains, greed starts to kick in, and our instinct is to buy those investments, hoping to get in before they rise any further. This can be even more clearly seen with the NASDAQ Composite Index and the dot-com bubble of 2000. From summer of 1995 to summer of 1999, stocks on the NASDAQ, many of them new internet stocks, had tripled in value over a period of just a short 4 years. To put that into perspective, that's effectively 30% annualized returns, which in no way is sustainable. However, despite this, in the short 9-month period following July 1999 to March of 2000, it was human greed and emotion that kicked in and pushed these stocks to bubble level valuations, as the Nasdaq almost doubled, up 80% in just those 9 months. Unfortunately for those investors who bought in at or near the peak, it would take roughly 15 years for those investors to break even. Trading on short-term emotions instead of long-term logic and reasoning and a rules-based system is why the average investor lags the market by such a significant amount. One might not think it'd make that much of a difference, but oftentimes investors' actions do more harm than good. So how can you avoid the pitfalls of the average investor and achieve long-term investment success? If you invest for the long term, understand that there will be some ups and downs. You will have the distinct advantage, and note this isn't a disadvantage, of ignoring all the short-term noise. Over a period of 20 years in the future, we're going to see more short-term financial bubbles, just as we saw in the last 20 years, whether that's internet stocks in 2000, home prices in 2007, or Bitcoin in 2017. There's going to be wild fluctuations in some markets where it seems like you can make money very quickly. Unfortunately, on the other side of the coin, someone will lose money very quickly as well. You don't have to play this short-term game and instead can focus on the long term, as that will help you achieve the highest long-term annual return from each of these asset classes, instead of impeding those returns with emotional-driven trades and mistakes. Warren Buffett has said that he wouldn't mind if the stock market closed for the next 10 years. This is because he's not worried about the day-to-day price fluctuations and is more concerned with the long-term value and returns. If you can align yourself with that long-term mindset, you're going to see long-term success. If you have a short-term mindset, you may see some short-term success, but you're going to have trouble and struggle achieving those long-term returns. Now, step 3 is where we actually begin to look at your investments, and this is where we'll start with asset allocation. When you're investing, there's various types of investments you can make, typically called assets, that generally fall into several broad categories called asset classes. For most people, their investment portfolio will have 3 main asset classes: stocks, bonds, and cash. Now we'll go through the advantages and disadvantages of each of those asset classes, as well as walk through a couple asset allocation examples and compare those portfolios in terms of risk and potential return. So the first asset class is stocks, and this for many people will be the largest allocation in an investment portfolio. Stocks are a very small equity piece or ownership of a business. When you're investing in stocks, you're investing in businesses. So when those businesses grow, you as a shareholder of that company stand to benefit. Typically, this is in the form of capital appreciation or rise in the value of your shares, and for many stocks, dividends, which are typically paid out in cash around 4 times per year. Because the value of your stock is proportional to the value of the company, there's both relatively high potential upside and relatively high downside risk if the company grows or fails, respectively. For inflation risk, I initially had stocks listed as medium, but I'm going to change that to low medium here. Inflation risk is effectively the risk of the value of your asset or investment being eroded away by inflation over time. Now, stocks generally don't perform exceptionally well during periods of high inflation, but over longer periods of time, stocks do better protecting against inflation because the returns paid out from stocks are dependent on the performance of the business, which oftentimes has the ability to raise prices, rather than bonds and cash, which typically only pay fixed interest payments that are more susceptible to inflation. Overall, stocks are best for long-term growth and capital appreciation, which is why for many, especially younger individuals, it is a large proportion of one's portfolio. Bonds are ownership in a company or government's debt. You're effectively lending your money to corporations or governments with the promise that they'll pay back your initial principal at some point in the future, plus interest payments until then. Because the maximum potential gain you can get from a bond is all the interest payments being paid plus your original principal back, the upside is fairly limited. However, the downside risk is limited as well. While there is the possibility that you might not get your money back if the borrower defaults on the loan, generally speaking, debt obligations take the highest priority for any corporation or government. So when times are tough for a company, they'll do whatever they can to make sure they're making their interest payments, even if that means foregoing dividends or other returns to stock shareholders. Because of this, risk from bonds is more limited compared to stocks, which is why it oftentimes is a complement to a stock portfolio. However, one risk with bonds, especially long-term or long-duration bonds, is the elevated inflation risk. During periods of high inflation, long-term bonds are one of the worst performing investments. This is because high inflation erodes the value of the currency, meaning that when you've paid back your initial principal, it's going to be worth a lot less in real terms, in terms of the amount that you can actually purchase and buy, compared to when you initially lent that money. This is a consideration to keep in mind when selecting the type of bonds to have in your portfolio, because the longer the duration of the bond, the more susceptible it is to interest rate risk. Overall, bonds are good for stable and higher levels of fixed income in a portfolio. Oftentimes, the interest from bonds is more than what you could get by investing in stocks and receiving income from dividends. The final asset class is cash. And when I say cash, I don't necessarily mean hard physical cash, but typically cash or cash equivalents within an investment portfolio. Typically, this will take the form of what's called a money market fund. These money market funds effectively act like a savings account, paying you a current rate of interest while keeping the value of your investments at a fixed $1 per share, so that downside risk is effectively minimal. Cash equivalent options like money market funds are effectively the lowest risk option you can have in a traditional investment portfolio. Money market funds do still have some inflation risk though, as the longer you hold them, the more the value will gradually be eroded away by inflation. However, one thing to offset that is the current interest rate that the fund generates, and the fact that the value of the fund is typically fixed at $1, which means it won't lose as much value during periods of high inflation compared to bonds. Overall, money market or cash holdings within an investment portfolio are best for maximum liquidity as well as for future investment opportunities. Now, this is a simple example of a portfolio asset allocation of 80% stocks, 15% bonds, and 5% cash. With 80% stocks, this is a fairly aggressive allocation, which may be suitable for younger investors with a long time horizon before they need the money, for instance, for retirement or any other long-term goal over 10 years or so. Those closer to or in retirement might prefer having more fixed income or bonds in a portfolio, which may provide higher levels of current income and less overall volatility in the portfolio. Overall, the greater percentage of stocks or equities in a portfolio, the wider the range of potential returns you can expect to see for your portfolio in any given year. On the left, we have a portfolio of 100% bonds and 0% stocks, and from 1926 to 2016, the best year for bonds returned 32.6%, while the worst year returned only -8%. The average annual return over that period was 5.4%. Now compare that to a portfolio with 100% stocks and 0% bonds. The best year for that portfolio returned 54.2%, but the worst year was down much more at -43%. The average annual return over this period was highest though at roughly 10.2%. While the past historical returns are no guarantee for the future performance of any of these portfolios, there are a couple things you can take away from this chart. One is that while stock-heavy portfolios have historically produced the highest rate of return, they did so with the highest downside risk. This means while it seems like an obvious answer to simply have a 100% stock portfolio, going back to step 2, if you don't have the right long-term mindset with a 100% stock portfolio, you're going to run into some trouble with your emotions when you eventually do hit one of those severe down years where you're down 30 or 40% in a year. If emotionally you can't handle that, you're likely to make a mistake that will put in jeopardy the higher rate of return that you risked so much for by having a very aggressive stock portfolio. For many people who want the long-term upside with stocks and equities, but want a more mitigated downside risk, you can pick a portfolio somewhere in the spectrum between these two extremes. For instance, that 80 stock, 20 bond portfolio that we saw earlier still achieves a very respectable average return of 9.5%, but the worst case downside is more limited than compared to a full 100% stock portfolio. Now, a common starting point and a very standard asset allocation is a 60% stock, 40% bond portfolio. If you have absolutely no idea where to start, this is a fairly decent spot. If you know in advance you're emotionally prepared and have the right long-term mindset with investing, you can reasonably increase your stock allocation to 75%. I would say though that if you have a stock allocation of 80% or higher, you should really make sure that you have the first two steps locked down, being your cash reserves, and have low or no debt. This gives you the solid financial foundation to put you in a position where you can take those extra risks because you can handle the downside if it comes to that and put yourself in a position to potentially reap the long-term rewards. If you'd like to explore other different portfolio allocations, I highly recommend the website portfoliocharts.com, which allows you to browse through a variety of investment portfolios and compare how each of them performed, both from a return and risk perspective. You can even do this for your own custom portfolio. For example, this is what it looks like for the classic 60 stock, 40 bond portfolio, where you can see various visualizations, including average annual returns, where the portfolio value would grow over time, drawdown risk to evaluate the historically worst case scenario for that portfolio, a heat map to see how that portfolio would have performed in any given year, and various other visualizations. Again, I highly recommend checking out portfolio charts to see how your potential portfolio would have performed in the past, both from a risk and return perspective. So with that, we finally get into step 4, which is what I'm sure many of you have been waiting for, which is where we select your specific investments that you'll be investing in, given that we finally have the prerequisite steps, a strong financial foundation, the right mindset, and we know our asset allocation. Now, when it comes to actually selecting the specific securities to invest in, there's hundreds, if not thousands of funds to choose from, and a near infinite combination of individual stocks if you wanted to build your own portfolio that way. However, the one option that I suggest that most all new investors start with is a simple index fund. Now, for those that aren't familiar with an index fund, instead of having an asset manager decide which stocks to have in a fund, the stocks are selected based on an index. There are many types of indices, but one of the most common is the S&P 500. Effectively, it's a collection of the 500 largest stocks in the United States. Another index is the Total Stock Market Index, which is a collection of all publicly traded US stocks. Index funds are generally beneficial to investors because they're very cost-efficient investments. Because the stocks are simply selected from an index, there's no need to pay an asset manager to choose which stocks to have in the fund. This in turn means there's very little cost for the fund to operate, meaning you pay very little fees in terms of a low expense ratio, meaning more returns end up in your investment account instead in the pockets of your fund manager. And over the long term, index funds have performed fairly well. Part of the reason being is that because they invest in such a large basket of stocks, your return will follow very closely to that of the general market. This means you're not going to completely miss out on any growth opportunities, for instance, Amazon in the past, as you'll be invested in at least a small portion of every stock that'll be the next Amazon. Now, when it comes to stock index funds, the top two funds I would look at would be VOO and VTI, which is the Vanguard S&P 500 ETF or exchange traded fund, and the Vanguard Total Stock Market ETF. It doesn't matter which one you choose between the two because both funds perform very similarly. This is due to a large overlap between what each fund is invested in. VTI, or the Total Stock Market Index, has a slightly higher allocation to small capitalization stocks or smaller stocks that aren't in the S&P 500 index. VOO, or the S&P 500, will have only those 500 largest stocks. Over the past 5 years, the S&P 500 has slightly outperformed the Total Stock Market Index. Either way, both funds do a very good job of capturing the US stock market at a very low cost to you. Later on, you could consider adding international stock exposure to your portfolio, but for most people, VOO or VTI would be a great starting point for your stock holdings. As for bonds, there's a wide variety of flavors to choose from. There's differences in credit quality, with some bonds being at a higher risk of default than others, and many different durations of bonds where there's more inflation risk or less. You can check out a previous video I've done on bonds in detail, but I'll be discussing two specific ones here. The first is the Vanguard Intermediate Term Bond ETF, ticker symbol BIV, as well as the Vanguard Short Term Corporate Bond ETF, ticker symbol VCSH. One of the best ways to compare bonds is by looking at the 30-day SEC yield, effectively the yield or interest rate that you would get from investing in this bond fund. For the short-term corporate bond fund, this is roughly a 2.8% yield. Comparatively, the intermediate term bond fund has a yield of 2.63%. Neither of those yields are particularly high, but each of those bond funds is more on the lower risk end compared to all the other bond options that are available. This is a chart of the price of these bond funds over the last 5 years, with BIV, or the intermediate term bond fund, in blue and the short-term corporate bond fund in red. Over the past 5 years, the price of these bond funds has been roughly unchanged, and that's what you would expect from bonds. Unlike stocks, which have the potential for capital appreciation, bonds don't have any potential upside beyond the interest payments that you'll receive. As such, while the price of the bond funds didn't change over these 5 years, you did receive 5 years worth of interest over this period. The intermediate term bond fund is a collection of high-quality bonds, with about 50% of them from the US government. The bonds in the fund have an average duration of 6.1 years, compared to an average duration of 2.5 years in the short-term corporate bond fund. This means that the intermediate term bond fund is a little more sensitive to changes in interest rate and inflation compared to the shorter duration bond fund. This is reflected in the slightly wider fluctuations you see in the blue line, compared to the red, which is more stable around 0. Now, if you wanted higher yield from your bonds, you could certainly pick riskier bonds. In that case, you'd likely go for longer duration corporate bonds, but that has a fair amount more risk compared to shorter duration and higher quality bonds. For me personally, I like to take most of my portfolio risk on the equity side of the portfolio, specifically the stocks, and keep my bond and cash or money market holdings relatively on the lower risk end. Again, the specific investments are up to you, but those are two options that I prefer for bonds. As for cash, since I use Vanguard, I'm very pleased with their money market fund options. The first option being the Vanguard Prime Money Market Fund, ticker symbol VMMXX, which has an SEC yield of 2.37%. The Vanguard Federal Money Market Fund, VMFXX, currently sports an SEC yield of 2.3%. Both options are extremely low risk, so it doesn't really matter which one you choose. However, the Federal Money Market Fund invests only in government securities, while the Prime Money Market Fund can also invest in other financial securities, including certificate of deposits from other banks and financial institutions. Overall, I like using these money market funds as my cash equivalent option because they pay a very competitive interest rate yield on the cash in my portfolio while I wait for better opportunities to invest and deploy that capital in the future. So those are my top 2 picks for each asset class: stocks, bonds, and cash or money market funds. But of course, by no means you're obligated to invest in any of them. Go ahead and do your own research first, but for most people, starting with an index fund before picking actively managed funds or before picking individual stocks is really the best way to go. It'll give you a core diversified holding for your portfolio, which will allow you to build off that in the future. Now finally, we're on to the last step, step 5, which is to set up a system and open a brokerage account of your own. This is the final step to put everything into action. Now, details on the specific type of account you can open, as well as the brokerages you have access to, will depend on your country and regulations. So I'll be discussing options specifically for US residents here, but the discussion on setting up an investment system is applicable to all investors. When it comes to the account you open, there's a couple retirement options, specifically if you're investing for the long term for your retirement, that may offer some attractive tax benefits to you if you're a US investor. Specifically, this would be a traditional retirement account like an IRA or 401k, or a Roth version of these accounts. This is compared to a standard taxable account that doesn't have any tax benefits, but it also doesn't have any restrictions. Traditional and Roth IRAs have limited liquidity, meaning that if you put money into these accounts, you won't have access to those contributions until you reach retirement age without taking a penalty. Taxable accounts, on the other hand, give you full liquidity and access to your investments. Traditional accounts give you a tax benefit now, allowing you to deduct contributions from your taxes, effectively reducing your tax bill today, whereas a Roth account provides tax benefits later, allowing you to withdraw your contributions after they've grown without paying any additional tax. Because of these tax benefits, the contribution amount, or the amount that you can put into these accounts, is limited for both the traditional and Roth accounts. However, there's no limit to how much you can invest in a regular taxable account. Traditional accounts are best for individuals who expect to have a lower personal tax rate in their retirement years. On the other hand, those who will benefit most from a Roth account are those who expect higher tax rates in their retirement years than currently today. The taxable account, while it has no tax benefits, is best for having the full liquidity and access to your capital at any time without any penalties. For most people just starting out, there's no issue with just starting with a taxable account at first, and then later on, once you understand your tax situation, you can decide to invest in a traditional or Roth retirement account. Once you decide which account type you'll be going with, you need to open the account through a brokerage. A brokerage will be the financial institution you're using to hold your investments with. Now below I have a list of a few options of brokerages that have low or no commissions. This means you'll pay minimal trading fees when you're buying funds in your portfolio. I personally use each of these 3 options myself and was very happy with the service. The most established of the 3 is Vanguard. They offer you commission-free trading on all of their Vanguard exchange-traded funds and give you a high level of control over your investments. Overall, Vanguard is a great spot and is probably best for core index fund portfolio holdings. If you're going to use index funds in your portfolio, Vanguard has arguably some of the best. In that case, it makes sense to open a Vanguard brokerage where you can benefit from the commission-free trading on their platform. M1 Finance and Robinhood are 2 relatively new online brokerages. Both offer commission-free investing on all stocks and securities. M1 Finance is great for passively investing in a selection of individual stocks and funds that you've chosen, and does this through investing with fractional shares. A benefit of this is that you can invest almost exactly to the proportions that you set without having to worry about buying a specific number of each shares. One of the drawbacks though with M1 Finance is that you have slightly less control over your investments. Trades are made only once a day and you don't have control over the exact price it executes during the trading window. Given that you don't have access to limit orders or other more sophisticated order types, this option is likely best for passive investors only. For investors who want more control and access to commission-free investing in individual stocks, Robinhood is likely the better option. Though for either M1 Finance or Robinhood, before investing in individual stocks, I recommend getting your feet wet first with index funds and then building out your portfolio from there. Now the final part is once you have everything set up and selected with your brokerage, you want to set up an investment system. You might not realize it, but the most important factor contributing to the growth in your net worth over time isn't necessarily the investments you choose, but it's actually how much you invest. Assuming you're contributing $1,000 a month to your investment account and achieving 6% annualized returns, over 20 years you'll accumulate close to $500,000. What you might not realize though is that the majority of that value came from contributions, not from investment growth. By the end of year 20, 51% of the value of the fund was directly from your monthly contributions. The remaining 49% was that of the cumulative growth that occurred in the account over time. What's interesting is that at 6%, it takes an investment roughly 12 years to double. However, in the case of your portfolio, it took over 20 years for the growth to double your net contributions. This highlights the fact that early on in the portfolio, the majority of the value of the portfolio is going to come from your contributions, not growth. The key to take away here is that growth and compounding of your investments will happen over time, but it will start very slowly at first and gradually accelerate over time. This means the most important thing that you can do right now for your portfolio is to set up a system of consistent contributions and stick to it. Because total portfolio value is so heavily weighted in contributions during the early stages of the portfolio, saving as much as you can, as early as you can, and as consistently as you can is one of the best ways to achieve long-term investment success. While there are no guarantees in life, if you can follow these 5 steps, I'm very sure you'll be doing quite well in 20 years, and even better in 40. I hope this video gave you a good framework for how to get started with investing. If you enjoyed this video or found it helpful, leave a like to let me know. It's the best way for me to keep track of which videos you like the most and get the most value from. And if you have any other suggestions for future videos you'd like to see, let me know in the comments below. Until next time, thank you so much for watching. My name's Michael, and I will see you in the next video.